Big market voice for today. We have a guest joining us right here in the studios with us for a change and not on the Zoom link. Joining me is Nikhil Khandelwal, MD of Systematix Group. Nikhil, lovely chatting with you. Lovely having you right here in our studios with us. Tell us, what are your thoughts about what's been happening in the market? September was turning out to be a very good month, contrary to what really happens in September. But last 1 week, the pace of downtrend has been quite alarming. We've given up almost all of those gains. Of course, focus is on all the tantrums that Trump is throwing. First IT, then pharma. He's training his guns on us, despite that camaraderie he had with PM Modi on his birthday. Why are we focusing so much on the US-India deal right now, given the fact that domestically things are firing up? We had the GST rate rejig, and the impact of tariffs on our GDP was supposed to be somewhere around 4/10 or 40 or 50 basis points as per experts. So why so much focus on US-India deal, and why is it dampening sentiment so much?
No, I think you're right. We are coming to the GST Bachat Utsav as Prime Minister Modi announced, and things were looking. And things are looking, I think from a domestic consumption viewpoint, we are actually entering into a phase, and especially during this festive period, we are entering into a phase where the consumption, the domestic consumption pace is only going to ramp up, right? So I think while all of that positive was getting built in, the fact is that India has a significant stake as far as the technology sector in US is concerned. And the India is also one of the largest export of products from India is pharmaceuticals. So technology and pharmaceutical sector both saw significant news coming over the last couple of weeks. So if you check numbers, India has about $85 billion of product exports from India to US, while we have close to about $150 billion of IT services exports to US. So the numbers are quite, it's significant in the context of what Trump has announced as far as the H-1B visa regulation and the increase in the pricing is concerned. The technology sector also happens to be close to about 10 to 11% of the index. So given the magnitude of what has happened now, how much impact it will have on an individual company or so will be a company-to-company analysis, but it was not that Indian IT sector was in the best of the phase anyways. And the prices were taking a hit, the margins are at all-time low as far as the technology sector is concerned, and now comes this, right? So I think this is a significant impact on the overall sentiment as far as services exports. It also has a potential impact on the GDP. So definitely those things are playing in the minds of long only investors, especially FIIs, who have further accelerated their sale in the Indian market. So you're right. I mean, September started on a good note. It felt like even the FII data was actually positive. But this kind of punches keep on coming, and this is quite significant. Whatever that impact may be in terms of the revenue guidance from the IT sector and all, but I think the sentiment-wise, this is a significant thing for any investor to look out for. Hence, the market will be in a little bit of a corrective mode as far as this sector is concerned.
Got your point. So let's talk about this sector in details. Technology, FIs had already sold a sizable amount of technology shares, right? Now with the visa curves and also the clarification that it's not an annual charge, it's a one-time charge. With all these developments, do you think the worst is already priced in? Because IT index has underperformed Nifty significantly, 22%, if you look at the year-to-date numbers. So do you think investors should focus on valuations more, or do you think these kind of news flow will keep coming and margins will keep going lower, and the recovery that everybody was baking in the second half of FY26, do you think that gets further delayed because of all this?
Yeah, I think the IT sector per se for us will be a long path to recovery, to stability in margins, to stability in even revenue guidance. We have to see that while the mid IT companies are able to adapt to these H-1B kind of changes quite well. In fact, they don't have such significant stake as far as H-1B visas are concerned, and on shore and offshore mix is concerned, the large companies, the Tech Mahindras, the Infosys, the TCS, actually they have the most significant stake in what's happening on the space. So if the big boys are in a kind of a phase where they are still figuring out their their pricing, their go-to market, their margin profile, I think the sector will be under. I'll not say it will have deep correction now, but creating wealth in the larger companies in the space might be a little bit of a challenge. We believe that smaller companies in this environment, small to mid-sized companies, might give fantastic opportunities, because it's not like there is a blanket levy on all the services which are getting exported from India. But definitely the H1B impact will be more on the larger guys. The smaller guys might actually tend to benefit from the overall trend.
So mid-sized IT, would that be a contra call from you?
It will be. It will
Okay,
be. I think mid-sized IT will throw a lot of positive surprises in our view, and we have been interacting with quite a few of them, and we are clearly seeing that they are actually much more nimble. They are much more clear on how they're going to pass through this phase. Yeah.
Sure. Let's also talk about pharma, because a lot of exports happen from the pharma sector in India, right? But branded drugs have been brought under the tariff net, not generics, but that will of course hurt US more if they do that. But do you see the possibility of that happening, given the rhetoric Trump has been adopting? And if that happens, really, would that be very nominal? How should you look at the pharma space? Because branded is very small, generics, that's huge.
Yeah.
So how would you look at pharma?
As I said, branded, the pharma is actually the second or third largest exported product from India, about $10-11 billion on an annual basis. So definitely anything which happens in the pharma sector is something of a massive hit on the economy and India-US trade relationships. The branded part, of course, as you rightly said, is not a very significant part of what India does export. And even if India does export, like Sun Pharma is probably the largest player, who has close to 15% of its revenue coming from branded pharma. And even Sun Pharma is not talking vocally about it. It looks like, the point of origin from where those pharmaceutical products come, all that will matter, and companies will still be able to tide over this part of the phase. Now, I mean, whether this will spill over to the generic part of the pharmaceutical sector, I think what I understand from our analysts is that is an area under inspection by the US authorities. They have been talking about it, but whether it will actually play out, it's only time and Mr. Trump will have to say, because nobody can really second guess. In fact, the highest hit because of this branded pharma is actually the US companies, so US innovators. They are the ones who are getting those products manufactured in Europe or wherever else, Mexico, Canada, etc., and bringing into US. So they are the ones who are the most hit by what this move is. It's actually not a very big hit on Indian markets. I think again, these are in a market which is so full of this Trump-related news. This kind of news flow probably gives you an opportunity to build your portfolio. And from our perspective also in this sector, we believe that a lot of negative flow started coming on Sun Pharma, Cipla, etc., who have close to about 30% of their sales in US, and in fact they are our best calls at this point of time. We believe that going all the way to the generic route is going to be even more dangerous road for Trump to go. So from that perspective, these two companies actually show significant value. So a lot of contra calls coming in because of these developments as well.
Sure. Any other contra calls aside of these mid-sized IT names and pharma names? Because one would want to spot value in this market, right? We've seriously come down quite a bit in the month of September. So where should one look for value in this market, aside of the ones that you already mentioned?
No, so we, I think over the past month or so, we have been, we even came out with a note on the banking space. And in fact, we have been tracking what's happening on the consumption, the GST front, Prime Minister Modi talking about Make in India, the repo rate cuts happening, so the interest rate cycle going down, and we saw that there's a great opportunity to build a strong portfolio in the financial space. And within the financial space, as we started to dissect data, we saw that probably the biggest value is sitting in the PSU banks. And over the past almost 4 weeks, we have been probably the loudest voice talking about why PSU banks need to be in your portfolio. These banks have grown over the past year faster than the private banks. They are actually having as strong a balance sheet as the private banks. They are actually going to see margin sustenance or margin improvement in an environment where private banks are likely to see margin pressure. And value-wise, they are available at half or probably 1/3 of the price. So that's where our contra call has been. It's actually not so much of a contra call. At that point of time, it seemed like, but looks like the market is already seeing a bit of rally in the PSU stocks over the past few weeks. So yeah, I mean, that's a pack which we strongly believe. The larger banks there, the Bank of Barodas, the PNBs, the Bank of Indias, so all of that is where you can play the consumption as well as the capex theme of India at a much better value.
Sure. Also the fact that there's a proposal to increase FIR limit in some of these, the PSU lot, right? So that's also boded well for the PSU banking sector as a whole. But since we're talking about banks, what are your thoughts about what the RBI is likely to do this time? Because there's a deep divide, a lot of factors to take into consideration. People are saying that, RBI may take a wait and watch approach just like Fed did. And some are of the view that, this is the time to actually dole out another cut because of inflation comfort that we have. Which camp are you in?
No, I think directionally it is going to be, I think the interest rate scenario is going to go south. We really don't know what's going to happen this week. I think there is a divide. We are of the view that RBI may hold on to any cuts this week since they have recently done a few cuts. So they are going to wait and watch, considering what is happening in the overall market environment. There are so many things at play. The USD INR is another thing which they have their eyes on. So combination of those factors, I think the directionally we will be seeing INR, the repo rate cuts happen. But from our perspective, I think it may or may not happen this week.
Okay, may or may not happen this week. Of course, all eyes will be on that. Wednesday is when the D-Day is. Of course, we'll be getting you live coverage on that. So don't forget to tune in for that. But Nikhil, in portfolios, what should the tilt be right now? Should one, have a large cap tilt, or should one look at value in mid cap more? I mean, in terms of portfolio construct, which way should one tilt?
No, I think these are interesting times, and I'll say from a portfolio construct, I think 50 to 60% needs to be large cap. And in India, you cannot outperform your portfolio without having a mid and small cap weightage. So I think, but given the value which has started to come in certain sectors, like we spoke, in BFSI, in pharma, in technology, and even in few other sectors, large caps have started to show significant potential for wealth creation. So in our view, it is 50 to 60% of the portfolio will be large cap, and the 40% will be small and mid cap. And I think from an overall portfolio construct, a large part of the portfolio needs to be domestic consumption dependent. There is of course, a lot of talk about, and a lot of stocks have shown run up. But whether it's make in India, or it's make for India, or it's consumption in India, I think these trends are something which we need to have in our portfolio. This is now going to be a 5 to 10 year theme. The kind of money which has come in the hands of the consumer is unprecedented. In the environment where the interest rates are going down. So from staples to discretionary to even the
Autos.
online, even the online companies like the Eternals, the automotive companies. I think there is even the financials. So there's a lot of way to play this space, and we need to build a portfolio around this category for sure.
And I think last time we interacted, we spoke about discretionary, autos, etc. What about high growth companies like Zomato's, the way you mentioned? Would you be comfortable with the valuations? Do you see room for more growth?
Actually, valuation is definitely reaching a point where you start to feel a little bit of discomfort. But these companies are changing the trajectory of growth. They are building in new areas of growth quite rapidly. These are these are going to be the platforms to play the mass consumption space. So I'll say you need to have these companies in your portfolio. We understand that the valuation may be a little bit ahead of the real earnings. So maybe the portfolio may not be too heavy on a company like Eternal, but definitely Eternal needs to be in your portfolio, and so would be a peer like Swiggy
for that matter. Yeah. Sure, and of late we've seen, since you mentioned Make in India, a lot of government deals for some of these names like HAL, etc. Railways also have once again come back on track, so to say. If you see the last 2-3 weeks, have execution concerns taken a backseat, and are valuations now looking okay, or do you think they are still looking expensive? Because order books are swelling, but the main concern was execution, right? Is that, or has that really taken a backseat? Is the market right in ignoring that?
You're talking about railways?
Railways and defence both.
And defence both. No, so I think within the government capex infrastructure, the larger theme, there are things which are happening poles apart. So we are tracking the railway sector. I think the railway sector for the last 12 to 15 months has seen almost negligible order flow from government. That's a sector which is actually at the worst of its cycle at this point of time. So the government, fortunately, for the year 21 to 24, gave a ton of orders. So companies are sitting with a reasonable set of orders, and hence that execution is at play. But for the last 12 to 15 months, no big orders have come. So I think railway as a sector, I'll say, still not a very hot and a positive sector for us at this point of time. You can play value there, because sooner or later orders will come. But it's a very heavy government dependent order inflow sector. On the defense, aerospace, and what's happening on that category across the board, whether it's small, medium, large companies, the government investments, their commitment, their payments to these firms is actually quite strong. And I think that space is rightly outperforming the broader markets. If you see the defense space, it is one of the 3-4 sectors which have outperformed the market, actually shown green in the past 12 months. So that's rightly because of the action which is happening on the ground, which is big orders coming to the Indian companies, a lot of global partnerships happening courtesy the government support, and I think that trend is expected to continue.
Okay, so that's the story when it comes to defense. But last question really, Nikhil, we're seeing primary market hustling and bustling with activity, right? This week itself, 21 new issues are opening. We have Tata Capital, PhonePe, all these companies coming out with the IPOs pretty soon. At a time when the markets are really cautious, secondary markets are really cautious, we're seeing correction again. But the spirits in the primary markets are fairly high. That doesn't really happen very often. We see companies getting jittery.
Yeah, in the April to June quarter, we saw that, right? Absolutely. Yeah.
So, but now, of course, there's renewed optimism, despite the fact that secondary markets are taking a backseat. Why this dichotomy? And secondly, of course, you guys also listing, I think on the 5th or 6th of October, if I'm not mistaken. What's your post-listing roadmap looking like?
Right. No, so we are already listed on BSE. We are listing on NSE, on the 6th. So looking forward to it. But to answer your larger question, it's a very interesting market. The GDP numbers are showing a level of strength, while the global macros are all over the place. Our INR USD is at an all-time low. So a lot of variances in the market. But what's one constant thing which is just ballooning month on month is the domestic capital flows into long only investors' hands, which is mutual funds, AIFs. So that flow of capital is unprecedented, right? And what's happening in parallel is that the larger, broader market where the listed stocks are there. If you want to play any of the sectors which we spoke about, the earnings and the valuation catch up. Actually, the valuation catches up much faster than the earnings. So you know, so a possibility to build a quality portfolio with quality names happens at a price, and the list and the primary markets, I believe, are giving a very interesting opportunity for investors to build into a diverse set of sectors, from technology, IPO to of manufacturing to pharmaceutical. I think we are getting probably the best breadth of or menu of offerings which are available. With Tata Capital now coming to the markets next week, WeWork coming also next week. So there is a slew of even more interesting sectors which are coming up in the market. So I think, and they are coming at a value which is probably 5 to 20% cheaper than their closest peers, which is available in the market. And if investors are getting a slice of it, they are more than happy. So yeah, I mean, our belief is that as long as the companies are large, are differentiated, and come at a reasonable price, the primary market activity will continue to kind of roll on, and we will continue to see much more action in this year compared to last year.
Sure. Okay, that's the word then from Nikhil. But with that, Nikhil, I think we're running out of time. I would like to thank you for taking out time and coming to our studios. Look forward to our next conversation as well. And I hope it's before Diwali, because I'm going to ask you your Diwali bets as well next time we interact.
Thank you.
Well, with that, of course, we've almost come to the end of this edition of Opening Bell. Markets, I think, are doing are in fine fettle. But before that, let's talk about all the action that happened on the battlefield last evening. We'll come to that, but let's talk about a message that we have for our viewers. Introducing Money Control Super Pro, your ultimate investment superpower. Get live calls, trading and investment ideas from SEBI registered experts, pre-identified chart patterns and AI-powered stock alerts on WhatsApp to help you trade and invest with confidence. Super Pro, where serious investors stay ahead. Download the Money Control app and subscribe to Super Pro today itself. All right, then, before we leave, we had a super